Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode, From Guesswork to Game Plan.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's show is From Guesswork to Game Plan, developing a tactical playbook for real estate investors. See, a game plan as a real estate investor is more important than a lot of investors realize when they first get started. How many of us have looked back on one of our deals, maybe a good one or a challenging one, and thought to yourself, boy, I really just winged that one. Maybe not in a reckless way, but you really just phoned it in. You got the opportunity, you made some calls, you ran some numbers really fast, and just hoped that your knowledge would carry you through. That approach always works until it doesn't. And many of us have had that experience. It's like things are just working, we're just winging it, and then all of a sudden it's like, wow, what happened? And you feel like you kind of got that slap in the head, right? So today we're going to talk about developing a tactical playbook. Not just another 100-page business plan that collects dust on your shelf, but rather a practical, repeatable decision-making framework you can use deal after deal in any market at all. No, it doesn't matter what your challenges are. You can use it time and time again. See, the key is fewer emotional decisions, fewer expensive lessons, and more constant results. So what is a tactical playbook? First, I think it's important that we realize what a tactical playbook is not. It's not a one-time checklist. It's not a guru's strategy you copied off Facebook or something that is cast in stone that can't adapt to changes in you, changes in the marketplace, changes in your financial condition. But what a tactical playbook is, it's a documented set of rules, triggers, responses that guide how you invest when conditions change. Think of it like a written strategy. Your playbook answers questions without emotion and keeps outside noise muted. Questions like, what sort of deals should I move on? When should I just walk away? How do I react when markets shift adversely? See, when we don't answer those questions in advance, then the market may answer them for us. They can answer with, steep prices all of a sudden. And then, next, then we want to start to look at things and go, why? I think it's important that we start with our nose in mind. This is where many real estate investors, I think, get it wrong or get it mixed up. They start making their playbook with the type of deals they prefer, the type of markets they want to be in, their expected returns. And that can be a bit backwards. Our first page should be titled, Deals I Do Not Do. Knowing what you won't invest in will bring clarity and help expedite your process. Let me give you some examples. I don't do ground-up development without a capital partner. The risk for me is just too high. I don't buy properties that require rezoning. Now, some people do. They just love to get into those kind of messes. But sometimes those can be, again, extremely risky, and they're not on my tolerance, side of the ledger. I don't invest in properties outside, my county, maybe your state. So everybody's going to be different. I have some investors, they don't invest outside of a 5-mile radius of where they live. Other investors will go, well, I'll do countywide. Some of them go, well, I only invest in these certain cities. Some of my students will look and go, well, I'm a little more risk tolerant. I'll invest anywhere in our state because I know the state laws and the rules. And some, will invest in neighboring states while others invest clear across the country. But you got to know what your no's are. I'm not, looking for properties, this, and this. So I do that. I have my own set. So I do, rezoning type projects, but I don't do them in certain areas. And that's on my no list. And so when a deal comes across and one part of it hits my no checklist, then immediately I know I don't have to go any further. There's no reason to run numbers on it. There's no reason to see what the margins would be. There's no reason to go any further with spending any more energy on it, because my no list helps to weed that out. All your no's make your future yeses easier. If a deal violates a non-negotiable, you don't need to evaluate it. You don't need to debate it. You don't need to sleep on it. You just move on. Next, my third step is you define your core yeses. This is where we move into the heart of the playbook. This is your core plays. Think in terms of a few repeatable deal types. You don't have to think of 10 or 15 or 20, just a few repeatable deal types. For each of your strategic investment moves, document. First, you might document the types that you will buy. Am I going to buy single family? Am I going to buy small multifamily? Do I want to do storage units? Do I want to do retail? I mean, you got to know the asset types that you're going to buy. That's the first thing there. The second is you want to define your buy box. Particulars like, what price range do I want to be in? Is my cap $1 million or is my cap, $200,000? You got to know your price range. You got to know the age of the properties that you're interested in purchasing. Some people only want to buy newer stuff, maybe 2010 and newer. Some people are just, no, I don't want anything newer than 1980, because that's just the market that they like. So you got to know that. You should document it. So when those come across, you go, hey, this is one that fits in my buy box. Unit count. Am I looking for single family? Am I looking for duplexes, triplexes? Will I go up to 8 units, or will they stick with 4 because of financing options that you can leverage with VA and FHA? You got to know your unit counts. Next would be the neighborhood class that you want to buy in. Are we looking to buy into inner city, maybe some rougher neighborhoods? Or are we looking only to be in the burbs and to buy, newer developments? Number 3, what would be your value levers? So, these are things that we want to look at, like, will the, asset support rent increases? If I buy this thing, can I build in scalable rent increases, or is it in an area that's pretty much flat, going to remain flat, and I'm not going to be able to do any automatic stepped rents on this property? Are there opportunities for expense reductions? Maybe you're buying multifamily and you see some huge areas where you can cut some expenses in a project. Those would be very significant. Can I reposition the asset? Can I convert this asset from maybe a long-term rental into a flip, or maybe into a co-living type thing? Are there any zoning issues with this thing? Are there any permitting issues with this property? Those are all things you got to think about. Number 4, what will my exit strategy be? Is this a property that is going to cash flow? Or is it something that, in order to get cash flow out of it, I got to refinance it shortly after I rehab it? Those are things that you need to know as far as your exits. Does this work as a flip? Maybe you go in buying the thing, buying the asset and thinking you're going to rent it. And by the time you get there, the conditions, and maybe it's in an HOA or a town that has become rent restrictive. And now, does it work as a flip? Is there another alternative on this? Conversely, you're buying a property as a flip and the market has gone sideways. Maybe does this thing work now as a hold? Can you generate some revenue till you get through this market phase and then sell the property off? Does this make more sense as a long-term hold, co-living? There's a bunch of different things that we need to look at for our exit strategies. And then next, number 5 would be document your deal killers. What's going to kill a deal for you? For me, like high crime areas, I tried to stay out of them. I have friends who invest. They love those areas because they can get the best deals in those areas, and they do really well in it. Is the deferred maintenance beyond your tolerance threshold? Now, I own a contracting company, so deferred maintenance doesn't bother us because we can do ground up. But for some people, there are things that if the deferred maintenance is too great, it's going to become a significant issue for them. They're not comfortable working with contractors, or comfortable with putting the program together. That's a deal killer, but you got to identify that. Is there something specific that would constrain this thing for being able to leverage it? Are there debt constraints? And those are things you need to know. And there's a reason that these things matter. See, when a deal crosses your radar, then with your playbook, you don't have to ask yourself if it's a potentially good deal. If it's on your no list, if doesn't fit in your buy box that you've documented, it's easy just to bypass it. So then, you can look at a deal and just start asking yourself, hey, does this fit in my buy box? And if it doesn't, then, it's not the deal for you. Maybe something you can pass on to somebody else. Maybe you can skim or make a couple $1,000 passing the deal on to another investor that you have, but it's not your deal. Even if you pass on the deal and your buddy picks it up, or you see somebody else pick this thing up and they crush it and they hit a home run with it, if it's not your deal, it probably wouldn't have been a home run, because if it didn't fit into your buy box, now the risk increases. That's not necessarily the deal that would have worked for you. And though they hit a home run with it, you may have just hit a fly ball out or a line drive, good hard line drive. This was a good property. We hit this one really hard. But at the end of the day, it was an out, not a base hit. All right, baseball analogy. How you like that? My point number 4 is game plan outweighs feelings. I think this is really important. There's a lot of investors that I've coached that when they are coming to me, a lot of times they're operating on emotion. They really don't have a documented strategy. But a game plan always outweighs feelings. Your tactical playbook needs to help you with your decisions and the rules so that you're not just operating on good feelings. Oh, this one just feels good. How many times have I had investors come to me and go, man, this deal it's just too good to be true. Or, man, I got this great deal on it. This feels right. And at the end of the day, they didn't make any money on it. And, some of them have even lost money. I mean, I had a very experienced investor that I was working with for a couple of years with their flipping business. And I remember they bought a property at an auction, and they were so emotionally invested in this thing. And by the time we backed out all the numbers and we got to the end of it, he barely got out by the skin of his teeth. Now, this was an experienced investor, but he operated on this one by his good feelings, and it bit him in the butt. And you don't want that to happen. So, here's kind of what I'm talking about. For me, I don't buy properties backed up to freeways, right? How did I develop this one? Because I bought a property backed up to a freeway, and we were flipping it, and we found out how hard it was to sell it. I just don't do that anymore, and how low the margins were in the profit, right? So now it's in my buy box saying, hey, this is one of the things I don't do. I don't buy properties that are backed up to freeways. That's me. I have friends who have rentals, and they buy properties backed up to freeway, and they put people in it. They get a little bit less rent, but they can buy the properties cheaper, and for them, the numbers work. But for me, I don't do it. I don't buy, leverage that exceeds my cash flow. I don't need any negative pulls every month. There are people that buy into equity markets, appreciation markets, and they'll buy the property. They'll lose money every month for years. And when interest rates go down, they can refinance it. And now they're cash flowing, but they're building the equity on the property, but they're losing cash flow every month. I don't do that. But there's a strategy for some people that works really good. I know in Robert Kiyosaki's book, he absolutely opposes that. He wants every property to cash flow on its own right out of the gate. And I think it's a good idea. And so I put that on my thing. I don't want to have things pulling from my reserves. I want things adding to it. And so sometimes I take a little bit less future profit by making sure my current profit stays there. I use these rules, kind of as guardrails. They don't guarantee success, but they're made to reduce my risk. Most bad real estate deals don't fail because the investor was dumb. The fact is, I can't think of any of the students that I've had that I would say, hey, that person's just dumb. They're not going to make it. No, the deals don't fail because the investor was done. They fail because the investor went outside their guardrails or beyond their expertise. The playbook is there to protect you from the obvious bad decisions and your overconfidence. So here's the fifth point. It's about having a market shift response plan. Okay, one thing I know from being an investor as long as I've been is that markets change, market shifts. We call them crashes sometimes, but it depends on what side you're on. A crash for somebody may be a buying opportunity for somebody else. But this is where a tactical playbook can separate hobbyists from professionals. This can be called if this, then that. I was trying to think of the term really quick, but if this, then that. So this is how we determine that if this thing happens, then we do that. So, for example, if interest rates rise, that is the this, right? This happened, interest rates rose, then our response might be we need to buy properties on increased margin. That would be the that. So in a great market, we're buying properties on thinner margin, we're selling them faster, we're flipping them faster, we got more opportunities, more willing buyers, more competition. But when things change, that may not be the case. And so we have to pass on some deals because the margins aren't there and we just take the fatter deals. Okay, here's another one. If long-term rents flatten, that's the this, right? This is what happened. Then we move to short-term rentals. That's the that. That's the response to it. So we create these scenarios. So, what happens if short-term rentals are outlawed? Well, then we move to long-term rentals. We got to have a response. When the market conditions change in a certain way, then we have to have a response to it. If we move to a buyer's market, then we may rent instead of flip, right? If this, then that. This isn't about being pessimistic. This is about being prepared. We are not predicting the future. We're simply preparing a predetermined response to potential market changes. And markets are going to change. Sometimes they move in a positive direction for us. Sometimes they move away from us in a negative direction, depending on your investing strategy. But changing economies and markets don't reward the smartest investors. They reward the most prepared ones. And here's my last point, point number 6. Turn your experiences into IP. What's IP? Intellectual property. The last piece is a big one. The playbook we create is not static. It's not cast in concrete. Every time we complete a deal, it should provide us some feedback that we can use to help shape our overall game plan going forward. After each acquisition or exit, we ask ourselves, which of my assumptions were wrong? What surprises did we encounter that we could have planned for? Is there something that we should have handled differently if this happens next time? Then you update your playbook. And over time, this becomes a proprietary intellectual property for you. This is now your strategic plan. This is how experienced investors move faster than the rest. They have this already built in. They're not searching for these answers. They have these predetermined plays. This is how they can raise capital fast with greater ease. This is also why chaos looks like opportunity to them. This takes a great part of the guesswork out of the equation. Here are a couple takeaways from today. If you aren't currently using a tactical playbook or don't have one, then you really don't have a defined strategy. You're just operating by instinct or emotion. And instinct or emotion generally requires a higher price to be paid in the long run. So start small with your tactical playbook. It can be just one page with one absolute, one set of rules, but write it down. Write it down so that it's firm and not easily changed. The most successful investors are those who make correct, constantly good decisions, even when there's market volatility. If you found today's episode valuable, I just ask you to subscribe. Leave us a review. Share this with another investor who needs to hear it. That's all we have for this episode. I want to thank you for joining me on the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes of real estate investing related topics. I'm glad you're part of our growing real estate investing community. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.